Hi, accounting students. Hey, one of your classmates suggested that I help you wrap your heads around these closing procedures. So here's my attempt at showing you how to do the closing entries, and we'll just do exercise 6.1 together. So in your textbook on page 172, the directions are to journalize the closing entries, and what they have given you to work with is the account balances from all the accounts. So not just the balance sheet accounts. The balance sheet accounts are assets, liabilities, and owner's equity, but also including the revenue and the expense accounts and the drawing account, things that you wouldn't see on a balance sheet. So we're looking at all of the accounts associated with this business. So we need to pick apart the pieces that we need to complete this problem. So to get started, whenever I'm doing closing entries, because I'm not an actual bookkeeper or an accountant, I have to refer to the steps to do them. In the textbook, right around the first few pages of the chapter, you'll see the steps to do the closing entries. But actually, if you look at the review portion of your chapter on page 171, the learning objectives for Learning Objective 6.1 really gives you a detailed step-by-step on how to go about the closing entries. Okay, so looking at page 171, the first step is the balance of the revenue account is transferred to income summary, and so we would debit our revenue and we would credit our income summary. So think of it this way: you're emptying out the revenue account. All right, so let's get started here. First, we need to write down that we're doing closing entries. Whoops. Wow, I can't spell. And I think it even told us what page number we are on in the general journal. Page 4. That is important when you're posting, because you need the page number when you're posting. I know it seems kind of funny that it's a big deal as we're doing this for practice, but and then don't forget we need to put the year of our business, and this one's in 2016, and the date is the end of the year, so that is December 31st. And now we're ready to empty out the revenue account. So think about revenue. Revenue is an account that has a credit balance. So if we're going to empty it, we would need to debit that account. So the revenue account is fees income. And when we look at our fees income amount on the bottom of page 172, the account balance is $53,750. So we are going to debit that. Once we post it, the fees income account will be empty. It'll have a zero balance, and that's what we're shooting for. We're getting rid of the balances in all of our temporary accounts. Temporary accounts are revenue accounts and expense accounts, and sort of the drawing account. The drawing account, you'll see as we go on. Okay, so we've debited the fees income, and then we need to credit this new imaginary account, not really imaginary, but called income summary. My accounting teacher used to say that the income summary account is something we need for like 5 minutes. It's just a tool to help with these closing procedures so that we can empty out our temporary accounts. So we are going to credit the same amount to income summary. For these, we do not need to have a description because we're doing our closing entries, so that describes what we're doing anyway. Okay, we're on step 2. The balance of the expense accounts are transferred to the income summary account. We debit income summary and we credit expenses one by one. Okay, so again, December 31st, we're going to be debiting income summary for the total of our expenses. So this number is not yet known, so we will come back to that, but we do know the balance of all our expense accounts. Okay, so we have depreciation expense, and our balance is $2,750. We're crediting that. Now our normal balance on all of our expenses is debit, so we're making an opposite entry here. $2,750. Next we have salaries expense. And that's $17,000. And next we have supplies expense. $3,000. Next we have telephone expense. Let's see, $2,600. And lastly, utilities expense. And that is $4,650. Okay, so we're finished writing down all the expenses. Now we need to total those numbers. So let's see, let me grab a calculator. Actually, by the time I find a calculator, you guys will be wondering what's going on with me. I'm just going to use a calculator sitting beside me. Hope you don't mind. 2750 plus 1700 plus 3000 plus 2600 plus 4650 equals $30,000. So now we're ready to put the total in the income summary of all of our expenses is $30,000. Okay. What? Where did I go? Sorry. Oh, there it is. Hold on. Stop. So sorry if I just made you a little sick to your stomach. Okay, so now we've emptied out all of the expense accounts and we've added the balance into our income summary account. And if I can carefully look back up here. Now, when you look at these numbers, our fees income and our income summary, when you look at these two numbers, you can kind of just deduce that we had a net income. If we had our income statement in front of us, we would be able to see that we were showing a net income for the quarter or the month that we were calculating, because the fees income that we did first was representing all of our revenue, and the income summary in the second entry was representing all of our expenses. Now we don't know about drawing at this point, but we can kind of just suppose that we made money this month. I doubt if we took a draw that was more than the difference between these two, which is quite a bit of money. Okay, so that's just something to kind of keep in the back of your head. Okay, so now we're ready for step 3. So I look back on page 171 on the chapter summary, and step 3 is the balance of the income summary account, net income or net loss, is transferred to the owner's capital account. Okay, so that was kind of what I was getting at there. So December 31st. Now we're going to move the extra, the net income into owner's equity. Now this is something that I have always done backwards. Instead of doing the debit first, I've done the credit first, because you always know that when you're increasing capital, it's going to increase on the credit side. Okay, so let's start with our credit instead of our debit. So that's Maria Hernandez capital. Okay, and the difference between or the balance of our income summary account at this point is $53,750 minus $30,000. And so the balance of that is $23,750. So that's the amount of our net income, $23,750. So that was, just on the side, $53,750 minus $30,000 equals $23,750. This is just a pretend that's not their number, but just so you can see how we calculated that. All right, and then we put that in income summary. And now income summary should be empty. So see, we used that account for 5 minutes. A little longer because of my talking, but really it doesn't last very long. Okay, and then also on this page, I like that it tells you that if income summary has a credit balance, you debit income summary and you credit owner's capital. If income summary has a debit balance, it would be the opposite. Now make yourself a little note on page 171. If income summary has a debit balance and you need to debit owner's capital, that means you had a net loss during the year. Okay, you had more expenses than revenue. That will happen often. Don't always think that you make more money than you spend. It's totally not always like that. Okay, we're on step 4. So on step 4, we need to close the drawing account. So the drawing account is like an expense. It always has a debit balance. So to close it, we're going to credit it, and we're going to take that money out of the capital account. So we'll start with Maria Hernandez Capital. And the drawing, where was that? Oh, they did take a big draw. They took a $26,000 drawing. So much for me thinking that they made money this month. And then the Marie Hernandez drawing will now be emptied. Okay, and your capital was originally increased by $23,750 with your net income money, but then the statement of owner's equity is going to show that you had a decrease in capital because of this large draw that the owner took out. Okay, so capital decreased this month. You can tell that. Okay, you'll have a more complete problem. I just wanted to get this a little bit smaller so we can look at the whole thing. Okay, so just kind of a review. Step 1, I'll go green. Step 1 is to empty out the revenue account. So you empty out the revenue account by debiting fees income, and you just look at your balance and you make an entry on the opposite side, which is a debit, and you use the income summary account for the first time to hold that second entry. Step 2 is to close out the expense accounts. Remember, on step 2, you do not know the total for the income summary until you put all of the expenses down, add them up. That's the total. Okay, then we did this little side math where we figured out that we had a net income of $23,750 for this period of time, and that's the amount of money that we needed to then debit in income summary so that we can clear out the income summary account at this point. So step 3, income summary is now empty. And then we add that income, net income, to Maria Hernandez Capital. Step 4, last step, is to add or subtract the drawing account from the capital. So you start with the capital account, look at your list of accounts and find out how much drawing was taken, and then you close the drawing account by taking out the exact amount that's in that account. Okay, those are the 4 steps for the closing. I hope this movie helped.